Good morning, everybody. Kirk Spano. It is February 17th, 2024. And boy, do we have a lot to talk about. I'm actually going to try to burn through it quick. A couple of things. If you haven't been reading your Bloomberg, and if you haven't been watching Bloomberg television, documentaries, and whatnot, you're just missing out. That channel, that newspaper just keeps getting better and better and better. The data, the writers, it's the New York Yankees of financial press. And there's no doubt about it. It's the best financial press in the world. I don't even think it's close anymore. I think them and the Wall Street Journal Group and Financial Times all used to be kind of on the same plane. Clearly, Bloomberg has gotten better and better, and the other two have stayed about the same. This is the one indispensable subscription that I think you need to have if you truly want to be informed. Is for $200 a year. Get Bloomberg and then download their app on your television. Great documentaries and news coverage. Great guests. I can't say anything bad about Bloomberg at this point. So we've been talking about the mini crisis in the commercial real estate sector, and I've been reading everything that I can about commercial real estate and the impact on the banks. Here's what we know is that there is going to be between a $500 billion and $1 trillion of write-downs across the banking sector for commercial real estate. And last year, when I was talking to you about some private equity real estate developments that I have potential to invest in and that you could invest in too if you want to talk about that, was that things were tightening up with the banking system. And that started right around June, July last year. And by September, it was hard to complete a deal that we wanted to complete. So it's on hold right now. And it turns out that the group that I work with decided just to buy the property outright. They know that they'll be able to develop it when rates come down, but the original owner of the property did not have the time to wait or the liquidity. So the guys that I work with are closing on the property imminently, and they're just going to sit on it until they can develop it, which you would expect to be this year sometime, at least to get the financing done and the demolition. It might take until next spring to do the building. In any case, that is the story across commercial banking and commercial real estate. The banks have been under the pressure from commercial real estate since last summer. And we saw New York Community Bank Corp have to cut their dividend and really rationalize their balance sheet after they acquired two banks the last few years, including Sovereign, which was one of the ones that went under. We expect that the Federal Reserve and the FDIC absorb a lot of the risk in these mergers, and they do, and they intend to. But New York Community Bank Corp still had quite the whack-in a couple of weeks ago. So why is that? Why are the banks under such pressure? It's because it takes a long time in real estate for the defaults and for the price changes to happen. So even when the banks do end up owning a property that is not paying rent and ultimately defaults on a loan, they don't lower the price tag for that property very quickly. And they can afford to sit on those properties with lower cash flow and a lower book value for a while, generally a little over a year. And that's where we're at now, is a lot of these banks are starting to run to the point where they haven't been getting payments on some of these mortgages in the last 90 days to 180 days. They are seeing the borrowers beg for concessions, and in many cases, the banks are already starting to take the keys back. It will take 2 more years, probably, give or take, for all of this to shake out. So what we really have is not an event that is developing, but really last spring, we started a several years process of cleaning up commercial real estate problem that the banks are facing, largely because of work from home. So COVID, this is another impact of COVID. I know nobody likes to talk about COVID, but it really has changed the world in so many ways. because now you have around 30 to 35% of all white collar work getting done at home. That's double what it ever used to be. And that has led to record vacancy in commercial real estate buildings, the Amazonization of retail real estate, of that type of commercial real estate, right? There's sub segments has already happened, but even that's accelerating. I talked to you about a strip mall that I wanted to buy back in September, maybe, and it actually did get a cash offer. So somebody saw what I saw and probably needed one of the units for themselves, which is what I was going to do. I was going to take a unit and I was going to give the old bank to my daughter, because it's a bank, two-story bank with a strip mall attached with 3 more units. And I was going to put my daughter's salon in the old bank, so she had 2 levels and could really make it a high-end salon, and it was a great neighborhood for it. She would have had a bank vault inside of there. I don't know what she would have done with it, but it would have been pretty cool to have the bank vault. And I would have been probably next door or 2 over. And at the very end, there would have been a coffee shop or restaurant, cafe, something. And who knows what the third unit would have been. This strip mall had sold for 1.8 million 5 years ago, and they got it for 1.2 million several months ago. That's a strip mall. So imagine the office towers around the country that were built in the last 5 to 25 years, and a lot of them, they keep re-rolling their debt, and they get to a point 2019 with a really high value on that real estate in 2018, and they refinance based on those numbers and that vacancy level, that occupancy rate. Now here we are 5 years later. This is why this is going to last a little longer, is because the loans basically due now, but it'll take time for them all to get into distress. And they have occupancy that's way lower, and they just can't pay the mortgage on that high principal amount that they set the last time they did the loan, because they cash out. They're not looking to ever have these buildings be paid for. They just keep cashing out every 5 years. And if property values don't go up, well, at the next reset, you're in trouble. Well, property values are down a minimum of 30% in almost every building out there. 50% has been pretty standard, and 70% in a lot of cases. Why? It's not just that their occupancy rates have dropped a lot, by a third in many cases. It's that there's no hope that those are going to get refilled as offices ever again. So Jerome Powell, talked about commercial banks last week on 60 Minutes, and he's been talking about being a little bit afraid of inflation. And this article here kind of covers 2 things that I'm covering now, which is there is still a small risk of inflation if there's some sort of short-term shock. It's hard to see anything out there. If something happens, it'll truly be a surprise. It'll be a black swan. I think it would be a small black swan. Everybody wants to point to, and the new idea is that there's a white swan, right? Something that you can see in the federal debt. Even Jamie Dimon, who wants to see the federal debt flattened out, acknowledges that we're still probably 10 years away from it being a problem. And if he's saying 10, then it's probably 20 or 30. So the federal debt's really not the problem. It is servicing that debt, which means that we do eventually need interest rates to come down so that inflation minus the interest rate is about 0, right? So you would expect the Fed funds rate to get to between 2 and 3% in the next couple of years. And that's what will help the banks overcome their commercial real estate problem, and it'll make their bond portfolios look better. As the mergers happen, and we've seen that slowly, because a lot of the banks truly don't know what their footing is. And so one bank will look at their balance sheet and say, well, I think we can manage this. And then they look at a potential merger partner and they're like, but can they? What are we taking on in risk if we do a merger? And the Federal Reserve and the FDIC have been very clear. They'd like to see more banks over that $100 billion level and make them more systemically important, because the mergers that I talked about a year ago really haven't happened yet. They're just changing the rules. They're saying, you know, we wanted you to merge so that you would follow tighter rules like the big banks. But since you're not merging, and this has been talked for a few weeks now, we're just going to apply those rules to you anyway, regardless of what size you are. So unless you're tiny, these rules are going to apply to you. So the mid-sized banks are being set up for a bailout, probably be a slow rolling bailout with a special facility, don't call it QE, but then tighter standards after the fact. And part of that will be if we give you money, you're buying US treasuries with that money because we won't hold that against you as interest rates fluctuate through mark to market. So this cycle that I've been talking about is likely going to play out well into next year. And during that time, and this is one of the programs that they've been working on, they actually had a test run recently, is they want banks to be able to go to the Fed window for managing their balance sheet without there being a stigma. I don't know if they can get rid of the stigma. However, right, the stigma is we have to go to the Fed, we might be in trouble. So the Fed is trying to destigmatize that because they know it's coming. I think they're going to be successful enough that these banks start fixing their balance sheets, buying themselves some time on selling this commercial real estate. And that's bad for me. I mean, I love to buy some of this stuff dirt cheap, but it's also bad for the hedge funds and private equity and whatnot. And I think they're seeing it. So in PitchBook and some of the other things that I read, it is clear that the private debt market, as I talked about a year ago, probably was taking on too risky of a portfolio. We've seen the high yield bonds risk premium really contract. So that's very negative for high yield bonds. And the moving parts are such that I think you're going to see people just do deals on anticipation of Fed lowering rates and money trickling into the system over the next couple of years. So rather than a lot of money all at once getting into the system, I think we should expect first quantitative tightening to get wound down. We've been set up for that to get an announcement in March. I think that the May 1st meeting is going to get the first rate cut. I think it'll be a half a point. I think they will couch it by saying, look, we're just taking the last rate cut off. We don't know if this is going to be an extended period of lowering rates. And that's how they will keep the markets from going crazy. But the reality is the banks need the help. The federal government needs net zero borrowing, which means that the Fed funds rate has to get down to about 3% soon. And then we have politics. Does that play a role in what's going on? On the one hand, they want to stimulate the economy so that President Biden wins. On the other hand, they want to leave in place some roadblocks if President Trump wins. Because remember, Chairman Powell will be the Federal Reserve Chair at least for the first year of the next president's term. How do the politics play out? Hard to know. But I think that we're going to see enough money getting put back into the system through the special facility, don't call it QE, meant to help the banks with strings and conditions attached, and for the banking system to start loosening up a little bit. There is a financial conditions index which got to its maximum level of tightness last March. And financial tightness has been loosening up since, all on the anticipation of lower rates. It's probably about as low as it's going to get. And I should have had that chart up. I don't know how good I am with this to get to it. Financial conditions. Hey, there you go. That was pretty good. So here's the financial crisis. Got really tight back then, right? It was hard to borrow money starting in 2007 all the way to 2010. You just look at the last 5 years, financial conditions aren't that tight. Peaked in 2020 because the world shut down, got really loose in here, which is what drove the inflation, slowed everything down. But financial conditions have been loosening up, and they're basically average right now. People want to stay tight, and they want to say interest rates are high. Everything is average, historically speaking. It's all normal. So when I write an article talking about the great normalization, there it is. Interest rates are historically normal, and it's true. And financial conditions for tightness or looseness are historically normal. That's true. So the question becomes, much like the question we ask about, do earnings matter? Do price to earnings valuations matter? And that's a question we asked several years ago. Are PE ratios permanently higher now than they were in the past? And I think the answer was yes, not as much as some people want, but definitely yes. And I think that we're going to see lower interest rates historically become normal until the United States starts running a more balanced budget, which I'm forecasting for the 2030s against the grain of everybody else. And of course, the reason I do that is because the demographics say that peak baby boomer expense to the economy is 2029, 2030, right? That's when the last baby boomer gets on Medicare, and the vast majority of them are taking Social Security. The number of people taking Social Security will gradually increase until about 2034 or 5, and then it'll turn over. That'll be a combination of a large group having reached 70, a small group behind them, which is my generation, the Xers, not being retired yet, right? There's going to be a gap of about 15 years, maybe 20 years, before we start to see another big generation get onto Medicare and Social Security, and that'd be the millennials. So starting in the middle 2030s, obligations to the baby boomer retirement start to fall, all during the millennial peak earning years, and hopefully into policy and an economy that creates an almost balanced budget. Doesn't have to be balanced, just has to be close, within 2%. And if interest rates on the real side are, say, 3% or 2% at the Fed as kind of the new normal that's coming, because we'll just pay off the debt over time, and we'll do it with a low coupon. So in the very short term, what should we expect, right? Because everybody cares about the next year. What's my trade? Well, I think for maybe a month, you're going to see this kind of flatten out or even tick up a little bit, but then it's going to head back down. So by September-ish, I'd say you probably see a number down around here. I don't know what my zigzag tool is, but little uptick and then a wave. So like this. So this little wave here, got another one last couple months, into April, May, then it's going to turn back down. I think that is what a lot of private equity investors are thinking. I think that's what most of the hedge funds are thinking. I think it's what the Federal Reserve is thinking. So over the next month or two, there will be some angst in the markets, I think, especially in March when Powell talks tough again out of one side of his mouth. And out of the other side of his mouth, by the way, we're starting to wind down quantitative tightening. Will there be a new extension of the lending facility that they put in place a year ago for the banks? That expires on March 11th. I forget exactly what day the Fed meeting's on, 15th, 16th, something like that. They might extend that quietly ahead of time and then explain at the meeting, hey, we extended it. We haven't put any new money into it, but we extended it because there's still money there. And we know that commercial real estate is putting a hurting on the mid-sized banks, right? The big banks are fine. The little banks are fine because they're not too into it. But those mid-sized banks are pretty hurting. So we want to stay away from the mid-sized banks until some more of this shakeout occurs. And I generally stay away from banks in general. This box here is a indicator that I've been using for 6 or 7 months now. I've been testing it. And it is based on institutional liquidity range. This is where the institutions say the price should be based on their interest. Takes into account dark pools and what we can see of the order book on the exchanges. So if a price is below this box, price will gravitate towards it to the upside. And if price is above that box, price will gravitate towards it to the downside. So this box acts as a magnet for price. To give you an example, let me show you the 5-year chart of QQQ. Actually, you want to go back to the bottom at the end of 2018. All right, cue my box. There it is. Guess I have to make that a little darker, huh? Hard to see. Oh, you know what this is? I was playing with another volume profile. So this is the long-term volume profile based on the chart that I'm showing. And then this other one is just based on the time frame that I picked. So since the bottom 2020, this is the volume profile. Shows there's a little gap in here. And look, this box is where the big support is, right? All this support, all this interest is basically sitting in this box right here. So we should expect a correction to the 350 range, 340 range maybe on QQQ at some point. However, I suspect, and I don't know this until I see it in real time, I suspect that this box moves up the same way that my target lines were moving up. So I'm using this because I was just doing it by hand and eyeball. This incorporates more quantitative data. So we're going to use this and then work off of that in the future. And I will get rid of that so it's easier to read. These numbers here are just different levels. Think of them as extensions in one direction or the other. And this 346, I think, probably acts as a target for QQQ if we get an actual bear market. I don't think that we're going to get the actual bear market. I think this level in here is what holds, at least in the short term. But I think we might get down to it pretty quick, like in a month by April. And then by May 1st at the Fed meeting, I think they lower interest rates. We start seeing the market go back up. And remember, stock market needs to go up for tax receipt purposes. Now, if for some reason the Fed decides, hey, inflation actually is scary, and they don't lower rates on May 1st, and right now the betting is that they're not going to. It's only a 30% chance, according to the futures market, that they're going to lower rates on May 1st. I think that's completely wrong. I think it's a great bet to take the over on that one. So if we get a price down here just under 400 on QQQ, I suspect that it's probably a buy. And that leads me to another discussion. I am not particularly interested in being overweighted to Tesla. And the problem I have in many accounts is that I'm using ARKW as a backdoor way of getting Bitcoin exposure for accounts that aren't set up for it yet. But that's got an 8% position or 9% position in Tesla and a big position in Roku. And I think that the analysis that's been out there the last couple of weeks, which is what you heard me say, man, 2 years ago, over 2 years ago, is that Roku has a lot of competition coming. We expect it to be on the wire through Comcast and through AT&T. And now Verizon is getting into that business over the air. The smart TVs all have the ability to download apps. Roku had first mover advantage, but it is no longer special anymore. Any TV can do what they do. So I don't want a big Roku position either. So that's my problem with ARKW, Roku, and Tesla. But even QQQ, Tesla is what, the 7th or 8th largest holding? Not interested in that either. So I'm looking for funds that basically give me all the upside of QQQ without Tesla. And it turns out that just your basic vanilla technology funds are probably the way to go there. So XLK is what's in the 401k that I manage, and there's a few others. So while we'll continue to keep track of QQQ, until Tesla has a steeper correction, I probably don't want it. So I'm probably going to get rid of it in the 401k temporarily. And if Tesla gets a correction of, well, probably to 300 something billion dollars, that's probably when I'd start to say, okay, I'm at least, it's at least neutral enough for me with some upside that I can get in there. But again, my problem with Tesla is that they shouldn't be bigger than Ford and GM, not by much. The idea that they're going to have autonomous technology anytime soon has been proven to be wrong every single year and will continue to be wrong. The AI is not built out enough. That's going to take years, probably into the 2030s. And even the sensing with the LiDAR and things like that, basically you can only get level 3 autonomous driving, maybe level 4 at some point later this decade. But the idea of having self-driving cars, which is level 5, it's really not even on the horizon yet. So while ARK Investments will talk about, robo-taxis could be a gigantic market, all that is a cannibalization of an existing industry. So it's money changing hands. It's not really new money. So we'll keep that in mind. But in a really bad correction, I think you see QQQ get down to the middle 300s. I'm not anticipating a real bad correction. I think we'll just get a typical breather, and then this should break out if the financial conditions stay loose and trend towards looser after a momentary tightness over the next couple of months. Moving on, Wall Street is warming to Big Shale after $250 billion in deals. Somebody asked about one of our shale investments online and was speculating, I think just spitballing a number because it wasn't grounded in anything, that Permian Resources could be a buyout target at 20 bucks a share. It's about 14 bucks a share now. That's just people saying, 14, so maybe 20. Yeah, it's a wrong way to look at it. Consider a few things. Number one, the price of oil has, I think, bottomed out. There is motivation by a lot of people in government, a majority of the people in government, particularly the bureaucracy, that has the luxury of paying attention to science, of driving the price of oil and gas higher so that we transition to cleaner fuels and solar faster. Interestingly, a nuclear reactor got approved this week using the molten salt technology that allows for a dramatic reduction in risk in a nuclear reactor. I don't think you're going to see fast moving infiltration of nuclear reactors, right? But you're going to see a handful of new ones get approved over the next few years. They generally take 5 to 10 years if there's no opposition to get built. So you're probably still not seeing a new generation of nuclear reactors until the 2040s, maybe. And that's if they can convince people that the molten salt for cooling, which allows them to run these nuclear reactors at lower pressure and dramatically lower risk of meltdown, if they can get the public to understand that. Mr. NIMBY and Mrs. NIMBY probably aren't that sophisticated. So we'll see how many of these nuclear reactors they can build. My guess is not many. If we get 10 to come online by 2040, just replacing the old reactors, I think that we are in pretty good shape. In any case, over on the oil side, the price of oil is likely to go up 2-3 years from now, 4 years from now, somewhere in there, because we're still at peak oil demand, still even have a little bit of growth in oil demand, not much, about 1% a year on average, big drop and then a rebound, and about 1% a year is what we're adding to oil demand. So it's pretty much on that peak oil plateau and will be until between 2030 and 2035. And sometime in that time frame, you'll start to see big nicks in the oil demand. It might be closer to 2035, which means that all of these oil companies that can use carbon dioxide tax credits, at least through 2032, they have a pretty good ramp. They have 8 years of big tax credits for ramping up carbon capture and sustainable aviation fuel, which they're tightening up the rules on, right? Not going to be any loopholes to get through. If you're going to do sustainable aviation fuel, you have to do it the way that Ametis is doing it, or at least work with corn producers who are doing sustainable farming. You can't just till the land and not count the carbon released because of that, is what the new rules say. Your carbon intensity score will be based on the full cycle, everything from the feedstock to the output to how you handle the waste. And that's probably a great rule if the goal is actually to bring down our carbon intensity as a society. Now, if we don't really care about reducing carbon, then we shouldn't be doing any of this in the first place, right? So if you don't believe in climate change, if you think that we can pump as much carbon into the atmosphere as we want, then why bother subsidizing the energy industry, right? Because if it doesn't matter, just let them go. The reality is that the entire energy industry is incredibly subsidized with special interest regulation rules across the board. The fact that we're still arguing about methane capture where they flare, look at the screen, that flaring there is methane. The fact that we have still allowed any of this, knowing for the last 30 years at least, and especially the last 20, it's easy to look at the temperature charts and the carbon charts. They move in lockstep. It's an echo. It's what you're seeing. As we've pumped more carbon into the atmosphere, more methane into the atmosphere, temperatures have gone up. The fact that we still allow flaring at all is mind-boggling to me. And the reason we don't is because the oil industry boo-hoos, we don't want to clean up our mess. I don't want to clean up my room. I don't want to clean up my room. That's the kind of shit that the oil industry pulls. It's bad for the economy if I have to clean up my room. Motherfuckers. So we'll see what goes on here, but it's pretty clear to me that big oil is not going the way of big tobacco, not just yet. I think they got a pretty good ramp through the end of the decade. So I really like energy across the board. Clean energy is beat to heck. Oil and gas is just starting to bounce back. I think Permian Resources as an individual company is set up to get much bigger or get bought out at a much higher price. The potential buyout is clearly in the 30s or 40s if the price of oil goes back up into the 80s or 90s. Interestingly, the LNG ruling or regulation or pause or whatever you want to call it, that basically says that after 2026 or 27, they don't want to see new LNG coming online, is good for you as a consumer because it means more of that natural gas will stay at home versus getting exported. Extremely volatile market. However, it spiked and then it crashed and now it's starting to go back up. If we would have continued exporting even more natural gas, one, goes against the climate change goals, but two, it would have made energy more expensive here at home. So during the tail run in this energy transition over the next 10-ish years, we don't want to have our natural gas get super expensive. We don't mind our oil getting a little bit more expensive because we want to get people out of oil-based cars, but we don't want them freezing or overheating because their natural gas got too expensive for their homes. Shifting buildings away from natural gas is going to take way longer, decades longer than shifting to EVs. Occidental is the easiest play because it's the safest in energy, because it has a patron in Berkshire Hathaway, one of the biggest companies in the world with the most cash on their balance sheet in the world, that's buying up Occidental. At some point, Occidental shares are going to scream higher, 90s over 100 maybe, just because there's not going to be many to buy. And as they pay down debt and switch to paying bigger dividends, there's going to be a ton of money there. Once their carbon credits kick in next year, I don't know, Occidental looks really good. So if you don't own Occidental, that's probably a really good one if you want something that doesn't have much downside, right? Because somebody is just out there buying it up for the long term and for all these tax credits that are coming. Ametis, which is my micro cap pick. People are like, oh no, Carb in California is gonna screw them. That's not what's going on. Carb with their LCFS, low carbon fuel standard tax credits and rules, are looking for ways to not spend money on importing biofuels. Now you have the crazies out there who want us to all stop eating meat. I call you crazies because God damn it, hamburgers are good and cows are nice. They're just happy creatures until we put a bullet in their head, I guess. In any case, cows aren't going away anytime soon. And they complain about the methane at dairy farms. But if you're capturing the methane, there's less methane at dairy farms. So it's not like capturing the methane is doing anything bad. It's actually capturing somewhere around half, maybe 40, maybe 60%, depending on the technology and how everything's built, but around half of the methane that these cows produce. Well, to me, that means we get to keep eating hamburgers. So, we'll see how that goes. And granted, a lot of it's dairy herds, but, we're finding out that we're going to still need dairy. It's just going to be not so much milk in the jug anymore. All right. So if Wall Street's warming up to Big Shale, that means there's a big rally coming. How that plays out over the next few years, always hard to tell. But I would imagine that we see a lot of these oil stocks go up, a lot like the small caps are going to go up in that 50 to 100% range. One of the things that you will want to read about is what's going on in Guyana because it plays directly into Exxon and Chevron. They have a documentary online about Guyana. This is where one of my friends spent a couple of years involved with their healthcare system. It's a very poor country, but it has the potential to get rich quick. So the question becomes is, does all that money go to a couple people or does everybody there get a higher standard of living? We shall see. It's at least something that people are talking about. And here's why climate change is important, why the topic will not go away. And again, you can maybe try to slow down the progress on fighting climate change if you are a fossil fuels forever person, but you're not going to stop what's happening. And as more climate issues become apparent to more people because of what it is they care about, it's going to continue to get stronger. It's going to become more and more politically relevant, and more people will vote based on saving the climate. If the polar bears can't eat, I really don't know what the ecological impact of that is other than the polar bear starving. I'm sure there's some circular thing there that makes it really bad. But if nothing else, it's an unhappy polar bear, and god damn it, polar bears are cool. Even if they might, club you and eat you if they see you. So you shouldn't expect climate change issues to ever go away, ever, unless climate change issues go away. Not going to happen. At some point in the next decade, you are going to see major cities get swamped. One of them will be an American city. My bet is on Miami, but it could be New York. Either way, when the next American city gets swamped by a storm, that will be another catalyst towards making the climate change rules tighter for regulations of fossil fuels, and probably drive even more investment into clean energy, and probably even start penalizing the fossil fuel companies finally by at least taking away some of their tax breaks and regulatory loopholes that let them do things like flare. So understand that these investments like Occidental and Exxon and Chevron and XLE, they are not forever investments. They are probably, this is the last time you can invest in them investments. And if we get a parabolic move up, you sell them all, every single one of them. And then your energy investments become clean energy and not nuclear, because again, maybe we get 10 new power plants in the next decade or two, but all that does is replace the ones that are going to have to be retired because they're just too old. All right, let me find Shooter and I will bring him on for a little major markets talk.